Sir, very happy morning to all. So we are doing the chapter capital gains. My dear lovable students, this is what we have understood in chapter capital gain. Full value of consideration, less expenses for transfer, net consideration, less cost of acquisition and cost of improvement. We will be getting short-term capital gain or long-term capital gain. From that short-term capital gain or long-term capital gain, we have to reduce the exemption under section 54, 54B, 54D, 54EC and 54F. You will be getting taxable short-term capital gain and taxable long-term capital gain. Able to appreciate? We have done the chapter, my dear lovable students. We are going to do questions. We are having ICI book back question. Nearly 8 questions are there. Question number 1. Mr. Mithun purchased 100 equity shares of Mrs. Good Money Company Limited on 1/4/2007. First of all, what asset he has purchased? Equity shares. Is equity share capital asset? Yes, sir. On what date? 1/4/2007. Before base year, after base year? After base year. So is it baby or Abhi? Abhi. After base year. Am I right, sir? At the rate of 1000 per share in public issue of company by paying STT. Super. So at the time of purchase itself, STT has been, with regard to shares, STT has to be paid both at the time of purchase and also at the time of sale. Then only it will be a super asset. Am I right? Company allotted bonus share in the ratio of 1:1 on 1/12/2024. Is it before base year, after base year? After base year. Any bonus share issued after base year should be, cost of acquisition should be nil. Am I right? But for super asset, one more cutoff date is there, 2018. Is this before 2018, after 2018? Hence, grandfather effect will also not applicable. Cost of acquisition should be equal to 0. He has also received dividend of 10 per share on 1/5/2025. Any dividend received should be taxable under the head IFRS. Always the dividend should be taxable under the head. Under section 56 subsection 2 class 1, that is the first income to be taxable under the head IFRS. Already highlighted. He has sold all the shares on 1/10/2025 at the rate of 4,000 per share through a recognized stock exchange and paid brokerage at 1% and STT of 0.02%. As per the 7th proviso to section 48, sir, any STT paid cannot be claimed as a deduction, whereas brokerage can be claimed as a compute is total income and tax liability for assessment year 26-27 if Mr. Mithun opt out of the default tax regime. That means that guy is traveling through, assuming that he is having other income of how much lakh? Fair market value of the shares of Mrs. Good Money Company Limited on 31/12/2018 is 2000, because this is a super asset. If you are purchasing super asset before the amendment date and if you are selling the super asset after the amendment date, the cost of acquisition will be special cost of acquisition under section 55, which is full value of consideration or fair market value as on date of amendment, whichever is lower or actual consideration, actual cost of acquisition, whichever is higher. Are you all really with me? Look, being a student, you should be able to handle these type of question in capital gain. Let me ask you one thing. Have the original shares purchased? Have we got bonus share? Have we sold all the share? So capital gain will come for everything. Come on, be with me. Long-term capital gain on sale of original shares. Actually, 2 shares are in hand. One is original share and bonus share. Gross sale consideration, basically full value of consideration. Tell me, one share has been sold for 4,000. What is the selling price of one? What is the selling price of one share? 4,000. How many shares are with them? 100 shares. Am I right, sir? So 100 into 4,000 comes to 4 lakh should be the full value of consideration. Any problem to anyone? Less brokerage at the rate of 1%. 4 lakh into 1% comes to. So the net consideration will be 3,96,000. Any problem? Less cost of acquisition. Since the asset is a super asset, special cost of acquisition provisions will be applicable, which is nothing but what is the full value of consideration per share? 4,000. What is the fair market value as on the date of amendment? They have given that fair market value as on date of amendment is, so 4,000 or 2,000, whichever is lower, comes to is the what of acquisition? Cost of or actual cost of acquisition. Sir, they have purchased 100 shares. Am I right? At the rate of how much per share? 1000 per share. That means 100 into 1000. 1 lakh. Basically 1000. whichever is higher, so you can claim 2000 per share as a cost of acquisition. Am I right? Sir, this 2000 into how much share? 100 share comes to should be the cost of acquisition, because now there is no question of index cost of acquisition at all. Even at the time of calculation of tax liability, don't sir apply index cost of acquisition, because that is applicable only for land and building. Am I right? So the long term capital gain is 1,96,000. Is this long term capital gain accrued or risen from super asset? Up to 1.5 lakhs is nil. Over and above 1,25,000, sir, it will be taxable at the rate of 12.5%. That will be the tax rate for this capital gain. Any problem? Come on, man. Coming to the, sir, bonus shares, man. Sir, how many bonus shares has been received? 1:1 ratio. How many shares was with you? 100 shares. So even bonus share will also be 100. All the share has been sold at 4,000. So 100 into 4,000, 4 lakh. Less brokerage at the rate of 1%. 4 lakh in 1% come to 4,000. So the net sale consideration will be 3,96,000. Any problem? Is this bonus share issued before base year or after base year? After base year. After amendment date or before amendment date? After amendment date. Amendment means meaning 2018 amendment. Am I right? Since the bonus share has been issued after 2018 amendment, the cost of acquisition will be nil. Because bonus means free shares. Am I right? So the short-term capital gain, because the bonus shares has been holded only for less than 12 months, will be 3,96,000. Sir, when the bonus share has been issued? 1/12/2024. And it has been sold on 1/10/2025. Is it more than 12 months, less than 12 months? So the gain will be a short-term capital gain. Up to this clarity. Note they have given, man, cost of acquisition of such equity shares acquired before 1/2/2018 is either the actual cost of acquisition, which is how much per share, or lower of what market value, fair market on the date of amendment, how much, or full value of consideration on the date of sale. So 2,000 or 4,000, whichever is lower. 2,000 or actual consideration 1,000, whichever is higher. 2,000. Therefore, the cost of acquisition of original share will be 2,000 per share. Any problem? STT cannot be claimed as a. So this is what the answer of long-term capital gain, 1,96,000. Look at here. This 1,96,000 is a long-term capital gain for what share? Original share. And 3,96,000 is the short-term capital gain for what share? Bonus share. Able to derive this? In between cycle gap, even they were having dividend income also. Am I right? My dear lovable students, how many shares you are holding? Original share 100 and bonus share 100. 100 plus 100? Sir, for one share, 10 rupees dividend given. 200 into 10? 2,000. That's what the income. 2,000, sir, will be taxable. Because totally original share 100 plus bonus share 100. 200 into 10 per share, 2,000. Any problem? Question itself said that. That guy is having other income of how much lakh? Will be taxable under IFOS. Other income 8 lakh. So the total taxable income will be 13,94,000. 13,94,000. Am I right? Sir, if you are able to derive the total income properly, capital gain chapter has been done. Now, this is what payable? Tax payable. In that tax payable, my dear lovable students, 111A, is there any limit excluded for 111A? No, sir. Will be taxable at the rate of 20%. You tell me what is the short-term capital gain income covered under 111A? So 3,96,000 into 20%. Now this will be the tax liability. 79,000. Sir, 112A. Is there any basic exemption limit for 112A? 1,25,000. So out of 1,96,000 minus 1,25,000 comes to into 12.5% comes to 8,875. Am I right? So look at here, man. These two income are special income, special rate applied. Whereas these two 8,02,000 are normal income. For that 8,02,000 normal tax rate will be applicable. Am I right? These people want to travel through what tax regime? Opt out of default tax regime. Opt out of default tax regime means optional tax regime means government asks you to travel through default tax regime. Timur pudiche edhula enga pora? Optional tax regime la pora. Then higher basic exemption limit will not be applicable. Only 2,50,000 will be applicable. Up to 2,50,000 nil. What is the total income? 8,02,000. In that 8,02,000, 2,50,000 no need to liable to pay any tax. Whereas second slab 2,50,000 to 5 lakh. What is the gap? 2,50,000. Understanding? Look, total income 8 lakh. 8 lakh. 8 lakh 2000. 8 lakh and 2000. My dear lovable students, 8 lakh 2000 should be classified into two categories. Two categories. Number one, first 2 lakh 50,000. This is what exemption limit? It is nil. Because since you are traveling through the optional tax regime, optional tax regime, you won't enjoy higher basic exemption limit. Because under the default tax regime, 4 lakh rupees is the basic exemption limit. Remembering? But there you will be getting only 2 lakh 50,000. The second slab, 2 lakh 50,000 to how much lakh? 5 lakh at the rate of 5%. Sir, what is a gap? 2 lakh 50,000. So basically 2 lakh 50,000 into 5% comes to, that's what, 12,500. Over and above 5 lakh up to 10 lakh. The next slab is 5 lakh to, but till 10 lakh not income we don't have because we are having only 8 lakh 2,000. So what is above 5 lakh up to 8 lakh 2,000? 3 lakh 2,000 into 20% because we don't have 10% slab at all. Direct 5%, then it will jump to 20%, then 30%. Are you agree with me? So 3 lakh 2,000 into 20% will be, so your tax payable comes to 1,60,975. Gross tax payable comes to 1,60,975. Any problem? Add health and education cess of 1,60,975 into 4%, 6,439. So 1,60,975 plus 6,439. What is the tax liability? 1,67,414 is the last digit. 5 rupee or less than 5 rupee. Put it on dustbin, sir. So 14 will be round off to 10. That's what 1,67,410. As per section 288A bar 288B. If you don't write that and all, no problem at all. Sir, straight away write that. Sir, more than 5 and above will be round off to next 10 rupees. Less than 5 will be round off to the earliest 10 rupees. Any problem? Question number 1 comes to 1. That's it. I'm moving into question number 2. RF convert is plot of land. My question, is plot of land capital asset? Purchased in July 2004 for 80,000 into what in trade? Stock in trade. In 31st March 2025. 31st March 2025 means financial year 24-25. 24. So 45 subsection 2. Conversion of capital asset into stock in trade. The capital gain will not be taxed in the year of transfer. Will be taxable in the year in which the converter asset is sold. Fair market value as on 31/3/2025 is how much lakh? Because till the date of conversion, it will be capital gain. From the date of conversion till the date of sale, it will be PGBP. Am I right? Stock in trade was sold for 3,25,000 in the month of January 2026. Our financial year 25-26. Any problem? CII has been given. Find out the taxable income, if any, and if so, under which head of income, for which assessment year is the question. Hello, sir. Actually, my dear lovable students, earlier it was what? Capital asset. Then it has been converted into. So by the time of sale, it is stock in trade you are selling. Then there is no question of capital gain taxability at all. But from the date of actual purchase till the date of conversion, income will be taxable under the head capital gain. What I'm trying to say is the new income will be PGBP income, which is nothing but what is actual selling price? 3,25,000. What is the fair market value as on date of conversion? So 3,25,000 minus 3 lakh. 25,000 will be taxable under the head PGBP. 25,000 will be profits and gains of business or profession. Am I right? With regard to capital gain, what is the full value of consideration? Fair market value as on date of transfer is the full value of consideration. How much fair market value? 3 lakh. Less cost of acquisition, index cost of acquisition. Sir, cost of acquisition of how much? 80,000. But when the transfer has happened in capital gain, when the transfer has happened, 31/3/2025. Yes. 31/3/2025 means financial year 24-25. Am I right? Financial year 24-25 is the year of amendment happened. In that, is it after July or before July? After July, there is no question of benefit of indexation. So from this 3 lakh, just reduce the 80,000. That's what 3 lakh minus 80,000, 2,20,000 will be what capital gain? The provision you have to omit. Conversion of capital asset into stock in trade is a within the meaning of section 2 subsection 47 in the previous year in which the asset is so. However, the capital gain will be chargeable tax only in the year in which the what is sold. the fair market value on the date of conversion would be deemed to be the full value of consideration for the purpose of the asset as per 45 subsection 2. The sale price less what market value on the date of conversion would be treated as what income in which the stock in trade is sold. Therefore, in this problem, both capital gain and business income would be charged to tax in the assessment year. Any problem? So, PGBP, for how much rupees really you sold? This 3 lakh rupees you already suffered under capital gain. So, extra 25,000 will be taxable under the head. Sir, really the fair market value on the rate of conversion was, this has been purchased for 2,20,000 is the long-term capital gain. So, total income comprised of both PGBP and capital gain, PGBP 25,000 and capital gain 2,20,000. Total of 2 lakh. Technically, if you see, my dear lovable students, this asset has been ultimately purchased for 80,000. Am I right? If you see, ultimately this asset has been purchased for, and ultimately this asset has been sold for 3,25,000. Are you all really with me? Calculator man, 3,25,000 minus 80,000. Total profit is 2,40,000. The entire 2,45,000 will not be taxable under capital gain. Entire 2,45,000 will not be taxable under. Some amount will be taxable under PGBP. Some amount will be capital under capital gain. PGBP, we all know that 25,000 is taxing. So 2,45,000 minus 25, 2,25,000. 2,20,000, yeah. 2,20,000 will be taxable as capital gain. Look at here, man. If you see the answer, 2,20,000 and 25, total 2,45,000. Ultimately, it is matching. Are you able to appreciate? Question number 2 comes to an end. I'm moving into question number 3, my dear lovable students. Mrs. Harshida purchased a land. You tell me, is land capital asset? At a cost of 35 lakh in financial year 24-25. 2004-2005. Sorry. Is it before base year, after base year? And held the same as a capital asset till 20th March 2024. That means, my dear lovable students, sir, before amendment date, cut-off date, fine. She started a real estate business on 21st March 2024 and converted the said land into stock in trade of her business on the what date? Said date, when the fair market value of the land was 210 lakhs. Am I right? That means conversion of capital asset into stock in trade. In the year of conversion, you are not liable to pay capital gain. You are liable to pay capital gain in the year of sale. She constructed how many flat? 15 flat of what size? Equal size, quality and dimension. Cost of construction of each flat was? Construction was completed in February 2026. She sold 10 flat at how much lakhs per flat? In March 2026, our financial year. So when you sell flat, this is Casa Grande. Income will be taxable under the head PGBP. Am I right? But till the date of conversion, income will be taxable under the head. The remaining 5 flat are held in stock as on 31/3/2026. That means capital gain will be taxable only for 10 flat. Sir, capital gain will not be taxable for 5 flat because it has not been sold. Capital gain will be taxable in the year of selling. Am I right? She invested 50 lakhs in bond issued by NAI on 31st March 2026. In the sense means when she transferred 21st March 2024. 21st March 2024 she transferred. Armason. If you want exemption under 54 EC, investment should be made within Armason. Hello, sir. My dear lovable students, from the date of transfer of the asset. From the date of transfer happened in 2024. But capital gain is arising, sir, only in our financial year. Am I right? She invested 50 lakhs in the bond issued by NAI on 31st March and another 50 lakh in Rural Electrification Corporation Limited in April 2026. We know the maximum exemption under 54 EC will be 50 lakhs. Hello, sir? Yes, sir. Sir, CII has been given. Compute the amount of chargeable capital gain and business income in the hands of Harshida arising from above transaction, indicating clearly the reason for treatment of each item. One of the expected question for exam. Because since I know CA faculty, sir, this is a CA final question. Earlier, it is there in CA final capital gain book. Now it has been shifted to the inter book. So this may be tested for the one of the 3 exams in the coming attempt. Are you really with me? Simple, man. Let me ask you. First, I am calculating the business income. Total, how many flat constructed? 15 flats. Out of that, how many flats sold? 10 flat. What is the sale price of 1 flat? So 30 lakhs into 10, total 3 crore. 3 kodi is the sale price. Am I right? Less cost of the flat. Sir, flat will be having 2 costs. Land cost will be there, plus the building construction cost will be there. Am I right? Construction cost straight away given in the question, sir, 10 lakh into for one flat. 10 lakh into how many flat? 10 flat. That means total 1 crore is the cost of construction. Am I right? My dear lovable students, for the land is a what asset? Capital asset. That land should be taxable under the head capital gain. Then the fair market value will be taken as the purchase price. Am I right? What is the total fair market value of the land on the rate of conversion? But in this 2,10,000, we have constructed how many flat? 15 flat. But we sold only 10 flat. So don't take the entire 2,10,000 as the cost of acquisition. Are you all really with me? So 210 lakhs divided by 15 flat into 10 flats na 140 lakhs, that is 1 crore 40 lakhs is the proportionate cost of the flat. Everyone understood that point? Because if I sold all the 15 flats na 2,10,000, 2 crore 10 lakhs, I would have reduced. But I have not sold all the flat. I sold only 10 flats. Then proportionate land cost should only be reduced. Accepting? So business income will be 60 lakh. 60 lakhs would be taxable under the head profits and gains of business. Or now I am calculating the capital gain. Why are you calculating capital gain? Because conversion of capital asset into stock in trade. Actually, conversion happened long years back. But now only it is getting taxable because year of taxability is not the year of conversion. Year of taxability is the year in which the converted asset is sold. Am I right? So what is the fair market value of land on the date of conversion? My dear lovable students, 2 crore 10 lakh. I know that this, sir, 2 crore 10 lakh is the fair market value for the entire land. Am I right? Out of that only land attributable to 10 flat has been sold. Remaining 5 have not been sold. Let it be there. Let it be there. My dear lovable students, let's expense for transfer. Nothing is there. When the date of conversion is the date of transfer. Am I right? Date of transfer is date of conversion. When they have converted, sir, 21st March. 21st March 2024. After March only April, May, June, July will be coming. So the conversion has been happened before the amendment. Am I right? Before the amendment, what is there? Benefit of indexation is there. Right. Then for how much rupees she has purchased? 35 lakh. This has been purchased in what financial year? In 2004-5, the CII is 113. That means calculator. 35 lakhs divided by 113 into, sir, in which financial year? As we all know that benefit of indexation can be availed only till the year of conversion. When the conversion happened? 23-24. Conversion happened in 23-24. Am I right? What is the CII of 23-24? 348. So the indexed cost of acquisition, what you are getting is 1 crore 7 lakh 78,761. Able to accept? So my dear lovable students, from the full value of consideration, 2 crore 10 lakh, if you reduce the index cost of acquisition, 1 crore 7 lakh 78,761, 1 crore 2 lakh 21,239 is the total long-term capital gain for the entire land. Let me ask you one question. Have the entire land has been sold? No, sir. Only land attributable to. That's why 10 divided by 15. Look here. 10 divided or 2 by 3. Both are one and the same, man. Max. So, out of this much capital gain, 1 crore 2 lakh 21,239. Am I right? Into 2 divided by 3 na 68 lakh 14,159 is a proportionate capital gain which has to be taxed in assessment year 26-27. Because in 26-27, out of the total land, only 10 land has been sold. 10 flats land has been sold. Remaining 5 flats land is still there as what in trade. Am I right? My dear lovable students, as per section 54 EC, if an assessee is transferring any land, building or both, and if he is investing in the NAI bond within a mason from the date of transfer, actually the transfer is happened. The transfer has been happened on the 21st March 2024. That means 23-24. After that, actually 24-25 ever gone. We are in 25-26. Am I right? They invested only on 31st March 2026. Hello, sir. Actually, it has crossed how much months? 6 months. They are not entitled to claim exemption under 54. Come on, come and see the note, my dear lovable students. Sir, yes, CBDT circular has been given. Oh my God, this is an additional information for you. Sir, in case of conversion of capital asset into what in trade? Stock in trade. Subsequent sale of what in trade? The period of etanna massam, RM massam should be from the date of sale of stock in trade for the purpose of section 54 EC. Because I will tell you what is the logic. Simple logic. I were having land, the land has been converted into stock in trade. In that year, what has happened? Transfer has happened. Have I sold the land? No, sir. That means I don't have cash. Then how 50 lakh will be invested? When I am getting cash, when I sell the flat, then only I am getting, then only 50 lakhs can be deposited. So, for the purpose of claiming 54 EC, massam should not be counted from the date of transfer only in this exceptional case. So, massam should be counted from the date of sale. So, go back to question. When, sir, date of sale? Sold 10 flats in the month of March 2026 and they deposited, sir, on or before 31st March itself, how much lakh? 50 lakhs. And another 50 lakhs in the April, sir, only 150 lakhs can be claimed. That's why exemption 150 lakhs can be claimed. So capital gain chargeable to tax for assessment year 26-27 will be 18 lakh 14,159. Any problem? What a beautiful question, my dear lovable students. One of the expected question for examination. Enna porthavaraikkum LDR last day revision question. Any point if you are having doubt, don't cheat yourself. Then this may be a 7-mark question in exam. I am telling you, this question was there in CA final book because I used to teach CA final. This question, this is Arshida question. Now it has been moved to CA Inter and they are testing. Sir, that's why in this question even circular and all coming. Am I right? In class, when we discuss the circular and all, we have not discussed because it's a CA final topic. But now it is there in Inter. This may be tested in exam. So come on, note number 1. Conversion of capital asset into stock in trade is a transfer. Will be treated as a transfer under 247. Am I right? Everyone read along with me. It would be treated as transfer in the year in which capital asset is converted into stock in trade. Which year? 23-24. As per 45 subsection 2, capital gain arising from transfer by of conversion of capital asset into will be chargeable tax only in the year in which the stock in trade has been, since the capital asset is converted into stock in trade in which year? Which is before 23/7/2024. Hence the indexation benefit for computing index cost of acquisition would be available only up to the year of conversion of capital asset into what in trade and not up to the year of sale of stock in trade. Am I right? For the purpose of computing capital gain in such case, fair market value of the capital asset on the date on which it was converted shall be deemed to be the or accruing as a result of transfer of capital asset. In this case, only 2/3 of the what in trade, basically 10 flat out of how many flat is sold in 25-26. Only proportionate capital gain would be chargeable to tax. Am I right? On sale of such stock in trade, dash income will arise. Business income chargeable to tax would be difference between the price at which the stock in trade is sold and fair market value on the date of conversion of capital asset into. In case of conversion, already we said when massam from the date of sale, not from the date of transfer. In this case, since investment in the bonds of NAI have been made within etanna massam from the sale of flat, same qualify for exemption under what EC. But as we all know that maximum exemption available under 54 EC will only be with respect to long-term capital gain arising on land on building or both in any financial year. Maximum deduction under 54 EC would be whether the investment in the bonds of NAI or RECL are made in the same financial year or next financial year or partly in the same financial year and partly in the. Therefore, even though investment of 50 lakh has been made in the bonds of NAI and investment of 50 lakh have been made in the bonds of RECL during 26-27, both within the stipulated 6 months period, the maximum deduction allowable for 26-27 in respect of long-term capital gain will be 50 lakhs. Lot of information we are getting. Are you all really with me? Sir, when there is a conversion of capital asset into stock in trade, income should be taxable in 2 heads of income. Number 1, PGBP and capital gain. Am I right? PGBP will be actual selling price minus fair market value as on date of conversion. Under capital gain, full value of consideration will be fair market value as a rate of conversion minus cost of acquisition or index cost of acquisition. The capital gain will be taxed. Am I right? Sir, we'll be doing one question, man. Question number 4. Very normal question only. Nothing big, nothing, sir, is there. Very easy question only. Come on, man. Mr. A, an individual carrying on business. Yes, let him, no problem. His stock, you tell me, is stock in trade capital asset? No, sir. Machinery. Is machinery capital asset? Yes, sir. Were damaged and destroyed in fire accident which occurred in December 2025. 45 subsection 1A received from insurance company. Am I right? That section is applicable only for machinery, not for stock. Value of stock lost, that is total damage, was 6,50,000. Debit entire 6,50,000 to P&L account because it's a business loss. Certain portion of the machinery could be salvaged. Opening balance of block 1/4/2025 was, that is WDV as on 30/1/2025. After providing for 24/25 was how much rupees? 10 lakh. That means 10,80,000 rupees was the opening WDV of the block. During the process of safeguarding machinery and firefighting operation, that means this guy has gone and fight with the fire, Mr. A lost his gold chain and diamond ring. You tell me, is gold chain capital asset? Yes, sir. Diamond ring capital asset? Oh my God. Gold chain capital asset and diamond ring also capital asset. Which he had purchased in April 2005 for rupees 1,20,000. Very long back it has purchased for 1,20,000. More than kalni virindu steal. Market value of these items as on date of fire accident was 1,80,000. Mr. A received the following amount from the insurance company. Insurance company compensated for loss of stock. How much? Nothing. Stock is pakka PGP item, right? How much stock lost? 6,50,000. Debit 6,50,000 in the P&L. How much insurance company gave? Credit 4,80,000 in the P&L. Net loss will be ultimately debited in the P&L. Nothing to do with the capital gain chapter. Easy. Towards damage of machinery. Look at here, man. What is the opening value of the machinery? 10,80,000. Right, sir? Yes, sir. Nothing is there. No addition, no deletion. 10,80,000 rupees machinery has been received for how much lakh? 6 lakh. So, machinery. What, man? Machinery. It's a depreciable asset. Section 50 will be applicable. Computation of capital gain in case of depreciable asset. For 10,80,000 rupees, insurance company gave only 6 lakh. Profit or loss? Loss. What is a loss? 4,80,000 will be short-term capital loss. Because always depreciable asset, na short-term capital loss or short-term capital gain. As the, that's it. Towards gold chain and diamond ring, 1,80,000. Sir, you tell me when gold chain and diamond ring has been purchased? April 2005. When it has been lost? December 2025. 25 means 25-26. Our financial year. My dear lovable students, that is the date of transfer. In the sense means the date on which the fire occurred only, sir, gold chain and diamond ring would have fall down. In the sense means that is the date of transfer. Is that after July, before July? After, surely after. Our financial means after July only. There is no question of benefit of indexation at all. Right? So, insurance company gave them 1,80,000. It has purchased for 1,20,000. So, 1,80,000 minus 1,20,000 will be long-term capital gain because this has been purchased in 2005. And sir, fire came only in 2000. Sir, that's it, man. You are requested to briefly comment on the tax treatment of the above 3 items under the provisions of Income Tax Act. First one, stock I am talking about. Stock kun capital gain ku sambandhame illada. Any compensation received from insurance company towards loss or damage to stock in trade is to be construed as what received. That means that loss should be debited to. Insurance compensation should be credited to. Hence, 4,80,000 received as insurance claim for loss of stock has to be assessed under the head profits and gains of business or. That means in your PBGP to loss of stock. What is the value? 10,80,000. That should be debited to 6,50,000. Yeah. Oh, okay. Sorry, sir. 6,50,000. Yeah, okay. Right. Fine. 6,50,000. Comfortable? 6,50,000 should be debited to P&L account by insurance company. How much received from insurance company? Okay, man. Is it net loss or net profit? Net loss. So 6,50,000 minus 4,80,000. 1,70,000. Already, sir, it will pull down the PGP because I have made extra debit in the P&L account. Adukum, capital gain, there is no sambandham. Am I right? So the assessee can claim the value of stock destroyed by fire as what loss? That's why I have debited to P&L account. Eligible for deduction while computing the income under the head profits and gains of business or. That means that 6,50,000 can be debited to P&L account. And my dear lovable students, I am entitled to claim that 6,50,000 as a deduction. Now compensation towards damage to what? Machinery. Question did not mention whether the salvage machinery is taken over by what company or whether there was any replacement of machinery during the year. Assuming that salvage machinery is taken over by and there is no fresh addition to the machinery during the year, block of machinery what to exist. If block of machinery cease to exist, section 50 will not be applicable, section 32 will not be applicable. Am I right? Section 50 will be applicable and section 32 will not be applicable. Am I right? Therefore, 4,80,000 being the excess of written down value over the insurance compensation will be treated as short-term capital loss. Because what is a block value? 10,80,000. For that, insurance company gave us a money of 6 lakh. So there is a difference of that 4,80,000 will be short-term capital loss. Any problem? If the machinery is purchased in the what year? Next year. It will constitute the what block? New block on which depreciation can be claimed for that year. That means now you are having money with your unknown. How much money? 6 lakh. With 6 lakh, next year you purchase new plant and machinery. Then new block will come. SR. For that new plant and machinery, next year you can claim depreciation. No problem at all. Compensation towards loss of gold chain and what? Diamond ring. Sir, gold chain and diamond ring are what asset? As per section 214. They are not personal effects which alone are to be excluded. If any profit or gains arising in the what year? Previous year, owing to receipt of the same shall be chargeable to tax as what gain? Capital. Capital gain have to be computed by reducing the cost of acquisition from jewelry of rupees 1,80,000. Hey, what is the insurance compensation received? What is the cost of acquisition? What is the gap? That 60,000 will be treated as long-term capital gain. Are you all really with me? Out of our 8 questions, my dear lovable students, we are done and dusted our 4 questions. We are having question number 5 pending. Hello, sir. We are having question number 6 pending. Hello, sir. We are having question number 7 pending. Hello, sir. And we are having question number 8 pending. Once we done the 4 more questions, we are done with the chapter capital gain. That 4 questions will be done in the coming slot. I believe that you are able to appreciate or understand whatever I have discussed till now. All those things has been, sir, discussed in the earlier part. I'm with you, sir, from your heart. Anybody is there? Where is a grand clap? Sir, very, very, very happy morning to all. So we are doing the chapter capital gain, my dear lovable students. In that we have done the first 4 book back question. We are supposed to solve question number 5, 6, 7 and 8 with that chapter capital gain comes to an end. I am proceeding to question number 5 as part of our discussion. Mr. S entered into an agreement with Mr. Jai Kumar to sell his residential house located at Kanpur on 16/8/2025 for rupees 1 crore 50 lakhs. First question to you, is the residential house property a capital asset? Yes, sir. Sir, in this advance money forfeited issues may come, in the sense means he has entered into an agreement on 16/8/2025 for a value of 1 crore 50 lakhs. The sale proceeds were to be paid in the following manner. This is how the 1.5 crores has to be paid. 20% through account payee bank draft on the date of agreement. Super. That is 1.5 crores into 20% means 30 lakhs to be paid as account payee check. 60% on the date of possession of the property. That means 1.5 crores into 60% means 90 lakhs. So total 120 lakhs done, remaining only 30 lakhs is there. Balance after the completion of the registration of title of the property, remaining 30 lakhs to be paid. This is the additional information. Mr. Jai Kumar was handed over the possession of property on 15/12/2025 and registration process was completed on 14/1/2026. He paid the sale proceeds as per the sale agreement. Fine. Everything has been pakka done. Mr. S has acquired the residential house at Kanpur on 1/4/2001 for rupees 30 lakh. It is after the base year. So no problem. We can take 30 lakhs as the cost of acquisition. After recovering the sale proceeds from Jai Kumar, he purchased 2 residential house property, one in Kanpur for 20 lakh and another in Delhi for 35 lakh on the respective dates. Anyway, that dates are within 2 years from the date of transfer. You have to check the amount of long-term capital gain. Then he is entitled to claim exemption under section 54. If it is less than 2 crore, 2 houses are allowed. If it is more than 2 crores, only 1 house is allowed. Compute the income chargeable under the head capital gain of Mr. S for the assessment year 26/27. CII has been given in the question. The value determined by the stamp valuation authority, 50C implications are there in the question. My dear lovable students, on 16/8/2025, what is 16/8? 16/8 is the date of agreement. On date of agreement, 1.7 crores was the stamp duty value. On 15/12/2025, what is the relevance of 15/12/2025? 15/12 is the date of possession of the property. That is, sir, registration process was completed only on this date, right, sir? 14/1. So this is date of possession and this is date of registration. So different stamp duty value has been given in the question. So we have to calculate the, sir, capital gain. A very good question because of various stamp duty values. First of all, computation of income chargeable under the head capital gain of Mr. S for assessment year 26-27. Actual sale consideration, you tell me. Really the residential house property has been sold for 1.5 crores. Two stamp duty value are there. Stamp duty value as on date of agreement and stamp duty value as on date of transfer. Stamp duty value as on date of agreement are 1.7 crores. 1.7 crores, which is straight away given in the question. Here students will get confused whether the date of transfer is 15/12 or 14/1. In a sense means 15/12 is the date of possession and 14/1 is the date of registration. If you see substance over form, once you are occupying the property means property is ready to use. That means transfer has been happened on 15/12/2025 itself. Only legally the document have to be transferred on 14/1/2026. Am I right, sir? So my dear lovable students, sir, since the advance has been paid by way of account payee check, how much advance? How much percentage? 20% through account payee bank draft. If you are having two stamp duty value, you can happily enjoy the stamp duty value as on date of agreement. That means two stamp duty value are there. Stamp duty value as on date of agreement and stamp duty value as on date of transfer. Here the transfer date is the date of possession. There is no doubt about it. Generally, the stamp duty value on the date of transfer will be higher as compared to stamp duty value as on date of agreement. Everyone love to take stamp duty value as on date of agreement. Here you can also take stamp duty value as on date of agreement. On the date of agreement, the stamp duty value is 1.7 crores. Am I right? You tell me, in place of 1.7 crores, really the assessee got only 1.5 crores. So is 1.5 crore less than 1.7 crore? Condition number 1 of 50C has been satisfied. Now condition number 2, the stamp duty value should exceed 110% of the consideration. So 1.5 crore into 110% means 1.65 crores. But the stamp duty value is 1.7 crores. Even condition number 2 also has been. Then consideration will not be the actual consideration. Consideration will be the deemed consideration under section 50C. So the full value of consideration will be stamp duty value on the date of agreement. Since it exceeds 110% of the actual selling price, that is 1.7 crores. Any problem? No, sir. Super, sir. Less, my dear lovable students, is the transfer of capital asset happened after cutoff date? Yes, sir. Because the transfer has been happened during our year. When you are calculating the capital gain, don't have a thought of benefit of indexation. Benefit of indexation will be applicable only in computation of capital gain. Am I right? So less what of acquisition? Cost of acquisition. The cost of acquisition of the house is 30 lakh, which has been pakka given in the question. Because Mr. Yes has acquired the residential house at Kanpur on 1/4/2001 for rupees how much lakh? So that 30 lakh, we can take it as cost of acquisition. Am I right, sir? My dear lovable students, then you will be having long-term capital gain 1.4 crores. Is that 1.4 crore less than 2 crore? Then assessee is entitled to claim two residential house property as exemption under section 54. So you look at it. Sir, one house of 20 lakh in Kanpur, another in Delhi for how much lakh? 35 lakhs. 20 plus 35. 55 lakh can we claim it as exemption under section 54 because since the amount of long-term capital gain is less than how much crore? 2 crores. The assessee is entitled to claim two houses as exemption. So the long-term capital gain chargeable to tax will be 85 lakhs. What is the requirement of the question? Compute the income chargeable under the head capital gain, nothing more. They have not asked about the tax liability. If they are asking about the tax liability, since the assessee is an individual, resident individual or HUF, if any land, building or both has been acquired before the cutoff date and transferred after the cutoff date, you are having two options. Either by taking indexation, you can pay tax at the rate of 20%, or without taking indexation, 12.5%, whichever is beneficial to you. Here, no such confusions are there because question have not asked about the computation of the tax liability. They just want the computation of the capital gain. When you are calculating capital gain, please don't think about benefit of indexation. Sir, note number 1, we are supposed to read it, and note number 2, and note number 3, and note number 4. Can we? As per section 50C, in your note, this section reference should be there, where the actual sale consideration is less than the value adopted by stamp valuation authority for the purpose of charging stamp duty, and such stamp duty value exceeds 110% of the actual consideration, then value adopted by the stamp valuation authority shall be taken to be the full value of consideration. Am I right? In a case where date of agreement is different from the date of registration, stamp duty value on the date of agreement can be considered provided whole or part of the consideration is paid by way of account payee check, account payee bank draft, electronic clearing system, or such other electronic mode as may be prescribed on or before the date of agreement. Am I right? In this case, since 20% of 150 lakhs is paid through what payee check, account payee check, or account payee bank draft, or electronic clearing system, or such other electronic mode as may be, on the date of agreement, stamp duty value on the date of agreement would be considered for determining the full value of consideration. Am I right? Since a residential house property was held by Mr. S for more than 24 months immediately preceding the date of its transfer, my dear lovable students, the residential house property is a long-term capital asset. Hence, the gain will be long-term capital gain. Since long-term capital gain does not exceed how much crore? 2 crores. He would be eligible for exemption in respect of both the residential house property purchased in India. Capital gain arising on transfer of long-term residential shall not be chargeable to tax to the extent such capital gain is invested in the purchase of this residential house property in India within how many years? 1 year before or 2 years after the date of transfer of original asset. Is every provision able to connect? Thus, he would be eligible for exemption of 55 lakhs being 20 lakh and 35 lakh invested on acquisition of residential house property in Kanpur and Delhi respectively. It may be noted that since S has transferred residential property on or after the cutoff date, which was acquired before the said date, he can opt to pay tax at 20% on LTCG with indexation or 12.5% on LTCG without indexation, whichever is beneficial to him. Very easy question, my dear lovable students. Since they have asked only computation of long-term capital gain, we are not calculating the what payable, tax payable. We are calculating only the long-term capital gain. Are you all really with me? With that, question number 5 comes to an end. Yes, man. We are moving into question number 6, my dear lovable students. Mrs. Yuvika bought a vacant land for rupees 80 lakhs in May 2005. You tell me, is vacant land a capital asset? Yes, sir. Land is a capital asset. Registration and other expenses were 10% of the cost of the land. That means, at the time of purchases, 8 lakh has been paid as registration cost, should be added to the cost of the asset. She constructed a residential building on the said land for 100 lakh during financial year 2007-2008. That means she has raised a building on that land. She entered into an agreement for sale of the above said residential house with Johar, not a relative, in April 2015. So, agreement has been entered into, my dear lovable students, to sell that property in April 2015. It will be after 2014. Am I right? The sale consideration was fixed at 700 lakhs. Oppa, 7 kodi. And on 23/4/2015, Mrs. Yuvika received 20 lakhs as advance in cash by executing an agreement. So, at the time of agreement, advance has not been paid by way of account payee check, account payee bank draft, electronic clearing system, or such other electronic mode as may be. However, due to failure on part of Mr. Johar, the said negotiation could not materialize, and hence the same amount of advance was forfeited by Ms. Yuvika. This has been forfeited on 23 for 2015, which is after 2014. That means this advance money would have been taxable under the head IFOS, under section 56, subsection 2, class 9. So in future sale, this advance money forfeited, no need to reduce from the what of acquisition? Cost of acquisition. Mrs. Yuvika again entered into an agreement on 1/5/2025 for sale of this house at rupees 810 lakh. She received 80 lakhs as advance as RTGS, specified mode. The stamp duty value on the date of agreement was 890 lakhs. You have to consider this stamp duty value. The sale deed was executed and registered on 14/7/2025 for the agreed consideration. However, the stamp duty value, Stamp Valuation Authority has revised the values. Hence, the value of property for stamp duty purpose was 900 lakhs. Mrs. Yuvika paid 1% as brokerage on sale consideration received. That is less expenses for transfer. Subsequent to sale, Mrs. Yuvika made the following acquisition or investments. Acquired 2 residential houses at Delhi and Chandigarh for rupees 130 lakhs and rupees 50 lakh respectively on this date, my dear lovable students. That means you are supposed to find out the capital gain and you check that whether it is more than 2 crore or less than 2 crore. If it is less than 2 crore, for all the 2 houses, you are entitled to claim exemption. Otherwise, only for 1 house, you are entitled to claim exemption. Acquired a residential house at UK for 180 lakhs on 23/3/2026. UK means outside India. You are supposed to purchase 1 residential house property in India. That means UK house is not entitled for exemption under 54. Subsequent to NAI capital bond approved under 54 EC for 50 lakh on 30/11/2025 and 40 lakh on 9/1/2026. If you are transferring a land building or both, an investment in the NAI bond with an massum from the date of transfer, you are entitled to claim exemption under 54 EC. CII has been given in the question. Compute the income chargeable under the head capital gain of Mrs. Yuvika for assessment year 26-27. Choice of exemption must be in the manner most beneficial to the assessee. In the sense means, we can claim only 2 houses. No, whatever 2 houses you can claim, that should be most beneficial. First question, capital gain. They have not asked, my dear lovable students, the tax liability. They just want the capital gain. So forget about the concept of benefit of indexation. Just work out it. So answer to me, sir, first agreement, put it on dustbin. Because there is advance money forfeited in case number 1. That advance money forfeited would have been taxed, already taxed under the head what? IFOS, no implication in this year. So the actual sale consideration is 810 lakhs. But the stamp duty value on the date of agreement is 890 lakhs. Am I right? My question to you is 810 lakh is less than 890 lakh? Yes, sir. Then, my dear lovable students, sir, 810 lakhs into 110% comes to 891 lakhs. Second condition has not been satisfied. Hence, deemed consideration under 50C concept will not be applicable. Only actual consideration will be the full value of consideration. So, the full value of consideration will be actual consideration since the stamp duty value on the date of agreement does not exceed how much percent? 110%. Am I right, sir? So, my dear lovable students, 810 lakhs will be the full value of consideration. Settled with FVC. Less expenses for transfer, brokerage, how much percent? So, 810 lakhs into 1% means 8.1 crores will be the expenses for transfer. Your net consideration will be 810 minus 8.10 comes to 801.9. Less, my dear lovable students, cost of acquisition. Am I right, sir? Cost of acquisition we have to take. Sir, cost of vacant land. For how much rupees you purchase the land? 80 lakhs. At the time of purchase of land, my dear lovable students, you have paid a registration fees of how much? 10%. So that should be added to the cost of acquisition. Am I right? So 88 lakh is the cost of land. Cost of acquisition of land. On that land, have you constructed any building? Yes, sir. What is the cost of construction of the building? 100 lakhs. Here, since we are calculating the capital gain, there is no concept of indexed at all. We have to just reduce the cost of acquisition of the land and cost of acquisition of the what? So total comes to 188. So the long-term capital gain is 801.9 minus 188 comes to 613.90. Am I right, sir? Less exemption under section 54. You tell me how many housemen? 2 house, 1 in Delhi. So first of all, let me ask you one question. Is the long-term capital gain, sir, more than 2 crore? Less than 2 crore? More than 2 crore. Only 1 house you are entitled to claim the exemption. Am I right, sir? My dear lovable students, 2 house at Delhi. Delhi for how much lakh? 130 lakhs. And rupees 50 lakh in Chandigarh. Will you go for Delhi or Chandigarh? Delhi. Because it is having higher amount. That's what they said. Please take the most beneficial one. Are you really with me? Anyway, there is no question of UK house at all since it has been acquired outside India. Am I right, sir? So for that 130 lakhs, we can claim exemption under section 54. Less exemption under 54 EC. My dear lovable students, when you have sold or transferred the residential house, what is the date of transfer? Registered on 14/7/2025 on July. That means July means August, September, October, November, December, January. Within January, investment should be made. The first investment has been made in November. Is it within our masam? Yes, sir. But this has been made on 9/1/2026. What is the date of transfer? 27, 14/7/2025. 14/7 July. So August, September, October, November, December, January. Hello, sir. Even this has also been made in January. Both are within the Aru Masam only. But 50 plus 40, 90 will be restricted to 50. In the sense means the maximum exemption, what I am entitled to claim under 54 easy will be how much lakh? 50 lakhs. So the long-term capital gain chargeable to tax will be 433.90 lakhs. Am I right, sir? My dear lovable students, where the actual sale consideration is less than the value adopted by the what valuation authority for the purpose of charging what duty, such stamp duty value exceeds 110% of the actual consideration, then value adopted by the stamp valuation authority shall be taken to be the full value of consideration as per 50 CR. However, where the date of agreement is different from the date of registration, stamp duty value on the date of what can be considered? Agreement can be considered, provided either the whole or part of the consideration is received by way of account pay check, account pay bank draft, electronic clearing system, or such an electronic mode as may be. In this case, since the advance of 80 lakhs is received by what? RTGS, that is one of the prescribed mode, stamp duty value on the date of what can be adopted? Agreement can be adopted as the what value of consideration. However, in the present case, since stamp duty value on the date of agreement does not exceed 110% of the actual consideration, actual sale price, sale consideration would be taken as the full value of consideration. Able to appreciate? Since a residential house property was held by Mrs. Yuvika for more than how much month? Immediately preceding the date of its transfer, the resultant gain will be a, sir, where the long-term capital gain exceeds how much crore? Capital gain arising on transfer of long-term residential property shall not be chargeable to tax to the extent such capital gain is invested in the purchase of how many residential house property? That too in where? Either 1 year before or 2 years after the date of transfer of the original asset. Any problem? Therefore, in the present case, exemption would be available only in respect of one residential house acquired in and not in respect of the residential house in. It would be more beneficial for her to claim the cost of acquisition of residential house at Delhi, that is 130 lakhs as exemption. Am I right, sir? Amount invested in the capital gain bond of NAI within Etanna Mason after the date of transfer. The date of transfer is, that is on or before 13/1. If you are investing till 13th of January, it's okay. Of long-term capital asset being land or building or both would qualify for exemption to the maximum extent of how much lakh? Whether such investment is made in the current financial year or subsequent finance. Therefore, in the present case, exemption can be availed only to the extent of rupees how much lakh? Even though you have made how much lakh? Even if both the investments are made on or before 13/1/2026. Am I right, sir? Advance of 20 lakhs received from Mr. Johar would have been chargeable to tax under the head income from what sources? Not now, earlier in assessment year 16-17 as per section 56 subsection 2 class 9. Since the same was forfeited on or after what date? 1/4/2014. What was the tax treatment? Till 1/4/2014, it has to be reduced from the cost of acquisition. On or after 1/4/2014, it should be taxable under as a result of failure of negotiation. Hence, the same should not be deducted while computing cost of acquisition. Am I right, sir? It may be noted that since Yuvika has transferred residential building, which was acquired before the cutoff date, she can opt to pay either 20% on LTCG with indexation or 12.5% of LTCG, whichever is beneficial to her while computing her tax liability. That means if you are able to do this question, every provisions of the capital gain will be able to revise. Are you all really with me? That's it, man. That's it. With regard to question number 6 also, we are pending only with question number 7 and question number 8. Are you feeling comfortable? Yes, sir. I'm moving into question number 7. Mr. Shiva purchased a house property on February 15, 1979. You tell me, is house property a capital asset? February 15, 1979 is before base year or after base year? Before base year for 3,24,000. This is the cost of acquisition. Am I right, sir? In addition, he has also paid stamp duty at the rate of 10% on the stamp duty value of rupees 3,50,000. So 3,50,000 into 10% comes to 35,000. So you have to add that to the what of acquisition? Cost of acquisition. In April 2008, Mr. Shiva entered into an agreement with Mr. Mohan for sale of such property of 14,35,000. That means already, sir, entered into an agreement. When the date of agreement? April 2008. Is April 2008 before 2014? And received an amount of 1,11,000 as advance. My dear lovable students, if any advance money has been forfeited before 2014, it has to be reduced from the cost of acquisition. However, the sale consideration did not materialize and Mr. Shiva forfeited the advance. That means in future, when you are transferring the capital asset, this amount has to be reduced. In May 2015, he again entered into an agreement for sale of said house for 20,25,000 to Miss Deepshika and received 1,51,000 as advance. This is the second advance the assessee is getting. However, as Miss Deepshika did not pay the balance amount, Mr. Shiva forfeited the advance again. But this has been forfeited on or after 2014. So, my dear lovable students, this would have been already taxed under what? IFRS. Whereas first advance should be reduced from the cost of acquisition. In August 2015, Mr. Shiva constructed the first floor by incurring a cost of 3,90,000. Am I right, sir? My dear lovable students, this 3,90,000 rupees is cost of improvement, which has been happened after the base year. So you can take it. On November 2015-2025, Mr. Shiva entered into an agreement with Mr. Manish for sale of such house for how much? 30,50,000 and received an advance of 1,50,000 as advance through what? Paycheck. This is the third advance he is getting. Am I right? Mr. Manish paid the balance entire sum and Mr. Shiva transferred the house to Mr. Manish on February 20, 2026. In a sense means, my dear lovable students, finally sale has happened. Because advance number 1 forfeited, advance number 2 forfeited, advance number 3 purchased. Mr. Shiva has paid brokerage at 1% of the sale consideration to the broker. On April 1, 2001, fair market value of the house property was 11,85,000 and stamp duty value was 10,70,000. Since the asset has been acquired before the what year? Base year. Then the cost of acquisition should be actual cost of acquisition or fair market value as on 1/4/2001, whichever is lower, whichever is higher, whichever is higher or stamp duty value, whichever is lower. Further, the valuation as per stamp duty authority of such house on 15th November was how much lakh? And on 20th February was 41 lakhs. CII has been given. Compute the capital gain in the hands of Shiva. Also compute the tax liability under 112, assuming that the basic exemption limit has been fully exhausted against the other income. That means straight away with indexation, without indexation, we have to solve. Come on, man. What is the stamp duty value as on date of transfer? 41 lakhs. Am I right? But really, for how much rupees this asset has been sold? For how much rupees really this asset has been sold? 30,50,000. Is 30,50,000 less than 41 lakh? Yes, sir. Yes, sir. My dear lovable students, now 30,50,000 into 100 and, sir, 10 percentage comes to 33,55,000. Oh, even 41 lakhs is more than 33,55,000. Am I right, sir? So actual sale consideration is 30,50,000. This is the really, for this much money only you really sold the property. Valuation as per the stamp valuation authority on the date of agreement. Look here, this is 41 lakh. When they have entered into an agreement, Mr. Shiva entered into an agreement for such house for rupees 30,50,000 and received an amount of 1,50,000 through what paycheck? Account paycheck. November 15, 2025 is the date of agreement. So on 15th November, only 39 lakhs is the stamp duty value. You tell me two stamp duty value will be there. Stamp duty value as on date of agreement, stamp duty value as on date of transfer. Am I right? Sir, if the advance has been paid by account pay check or account pay bank draft or electronic clearing system or such other electronic mode as may be prescribed, we can take stamp duty value as on date of. Don't, sir, Haribarila, don't take stamp duty value as on date of transfer. Please check two stamp duty values are there. Now compare everything with 39 lakhs. Is 30,50,000 less than 39 lakh? Yes, sir. My dear lovable students, sir, 30,50,000 into 110 percentage comes to 33,55,000. But the stamp duty value is 39 lakhs. Then deemed consideration concept will be, in the sense means, my dear lovable students, actual sale consideration 30,50,000. But value as per stamp valuation authority on the date of agreement is 39 lakhs. Am I right? What is the deemed full value of consideration? 39 lakhs. I will not take 30,50,000 rupees as the full value of consideration. I will take 39 lakhs as the deemed consideration because the actual selling price is less than the stamp duty value and stamp duty value exceed 110 percentage of consideration. Less expenses for transfer. Tell me, man, sir, for how much rupees this has been fixed? Sale consideration 30,50,000. 30,50,000 into 1 percentage comes to 30,500. So the net consideration comes to 38,69,500. When you are calculating capital gain, don't think about benefit of indexation. Less what of acquisition. My dear lovable students, the cost of acquisition. Really, the property has been purchased before before base year. Am I right? Then cost of acquisition is fair market value as on 1/4/2001 or actual cost of acquisition, whichever is higher. What is the cost, man? Calculator. 3,24,000 plus 35,000 comes to 3,59,000 is the cost. 3,59,000 is the cost. Am I right? 3,59,000 rupees is the cost. Sir, or what is the fair market value as on 1/4/2001? 11,85,000. This is the fair market value as on 1/4/2001. So you tell me 11,85,000 ya illa 3,59,000. 11,85,000 because whichever is higher, but it should not exceed the what duty value. So 11,85,000 or 10,70,000, whichever is lower comes to 10,70,000. Let me ask you one question, my dear lovable students. Is there any advance money forfeited? Actually, two advance money forfeited are there. One is before amendment, that is 2014. Other number two is after 2014. After 2014 would have already been taxed under what? IFOS. Am I right, sir? Whereas, my dear lovable students, before 2014 will be reduced from the cost of acquisition. Less what is reduced from the cost of acquisition. How much is the advance money forfeited? 1,11,000. So 10,70,000 minus 1,11,000 comes to 9,59,000 should be the cost of acquisition. Everyone able to appreciate? Less cost of improvement. Is there any cost of improvement? Yes, sir. The cost of improvement is 3,90,000 because constructed the first floor by incurring a cost of 3,90,000. Am I right, sir? So long-term capital gain will be 25,20,500. Sir, the same note they will be repeating, man. You have to read it, man, because same story. If an assessee is transferring any land, building or both for a value less than the stamp duty value and stamp duty value exceeds 110% of the consideration, then stamp duty value should be adopted as the full value of consideration. Any problem? Sir, here since the stamp duty value on the date of agreement exceeds 110%, that stamp duty value will be treated as the full value of consideration. Am I right, sir? Now I am calculating the tax liability. Now, sir, since the assessee is a resident individual, that resident individual has transferred land, building, or both, is having how many options? 2 options. My dear lovable students. Option number 1, sir, without taking indexation, pay tax at 12.5%. That's what we have done. 25 lakh 20,500 into 12.5% comes to 3,15,063. This is option number 1. Am I right? Or rework the capital gain by applying the benefit of indexation and pay tax at 20%. Come on. Net sale consideration. Already we worked out. 38,69,500. From here only the answer will change. Am I right? Because full value of consideration less expense for transfer will be mutatis mutandis the same under both. Less what of acquisition? Indexed cost of acquisition. It's not cost of acquisition. Indexed cost. What is the cost of acquisition? 9,59,000. 9 lakh? This 9,59,000. When you really purchase the asset before base year, that means 100 will be the index cost of acquisition. So divided by 100 into, in our year it has been transferred 25, 26, 376. Am I right, sir? So my dear lovable students, sir, what divided by what into what? 9,59,000 divided by 100 into 376 comes to 36,05,840 is the indexed cost of acquisition. Am I right, sir? Come on, man. Indexed cost of what? Improvement. Index cost of improvement. Sir, already given cost of improvement as 3,90,000. Am I right? So 3,90,000 divided by when the, what is the year of improvement? What is the year of improvement? When the improvement has happened? Sir, point number 6. Point number 6. In August 2015, that means 15, 16 only, improvement has happened. So divided by 254. Am I right? So my dear lovable students, sir, 3,90,000 divided by 254 into 376 comes to 5,77,323. So it is leading to a long-term capital loss. Long-term capital loss means I am not entitled to pay what at all? Tax at all. Are you all with me? So without indexation on the capital gain, what I have calculated here, 25,20,500 into 12.5%, 3,15,063. Add health and education says at the rate of how much percent? 4% on this value. So this will be the tax liability. If you are traveling through option number 1 without indexation. But with indexation, sir, it is a capital. Sir, since the computation results in a long-term capital loss, if indexation benefit is given, then tax under 112 would be nil. Are you able to appreciate? However, this computation is only for determining what liability. The said loss can neither be set off nor be carried forward. That means don't pay any tax. That's okay. But don't think that that loss can be what forward? Carry forward. And it will be affected against the other income. Are you already with me? So ultimately, this guy is not liable to pay any tax. Sir, cost of acquisition, we already done, man. Sir, what is the real cost of acquisition? 10,70,000. Am I right? Sorry, the 10,70,000 rupees is the fair market value or the stamp duty value fight. But 3,24,000 rupees is the cost of acquisition. On that, you have paid stamp duty value of 35,000. So 3,59,000. Already advance money forfeited is there before 2014. So the cost of acquisition will be 9,59,000. We separately calculated. What is the problem? Am I right? For that, note has been given. Where any advance money has been received by assessee and retained by him as a result of failure of negotiation, Section 51 will be applicable for advance money forfeited before 2014. Am I right? The advance retained by assessee will go to reduce the what of acquisition. Accordingly, cost of acquisition after reducing the advance money forfeited, which is 9 lakh, which is nothing but 10,70,000 minus 1,11,000 will be the what of acquisition. Whereas any advance money has been forfeited on or after 2014-15 onwards, it will be taxable under the head IFOS, sir. It will not be reduced from the what of acquisition, cost of acquisition. Very normal and good question, my dear lovable students. The only highlight is the tax liability. That means calculate the capital gain without benefit of indexation, apply 12.5%. Or rather, in your computation, calculate the tax liability with the benefit of indexation and apply 20%, whichever is beneficial to you. Here in this case, the beneficial is with indexation because there is no tax liability at all. But don't have over dreaming in the sense means don't think that you can set off or you can carry forward that loss, my dear lovable students. Are you all really with me? That's it with regard to question number 7. And we are pending only with one question, question number 8. With that, chapter capital gain comes to an. Yes, sir. We are moving into the last question, question number 8. Determine the capital gain or loss on transfer of listed equity shares. You tell me, listed equity shares are super asset. Super. STT paid both at the time of acquisition and transfer of share. Now only it is super asset. And units of equity oriented mutual fund, STT paid at the time of transfer of units. With regard to units, you are liable to pay STT only at the time of transfer for assessment year 26-27 and tax if any payable thereon in the following case, assuming that these are only transaction covered under 112A during the previous year 25-26 in respect of the assessee. They themselves said that it's a super asset, 112A asset. Mr. Shagun purchased how many shares? 300 shares in A Limited on 25-2017 at a cost of how much per share? 2017 they have purchased. 2017, is it before 2018? Yes, sir. Grandfather effect provisions will be applicable. He sold all the shares of A Limited on 31/5/2025 for 1,200. The price at which these shares are traded in the National Stock Exchange on 31/1/2018, 31/1/2018 is equal to 1/2/2018 is as follows. 3 price has been given. Sir, highest price, average price, lowest price. Sir, we have to take the average price because we won't be either extreme, highest extreme or the lowest extreme. Mr. Raj purchased 200 units of equity oriented fund, Fund A, on 1/2/2017 at a cost of how much per share? Yes, sir. Sir, next one, units of equity oriented fund they have given. For how much rupees it has purchased? 550. These units were not listed at the time of purchase. At the time of purchase, these units were not listed. Subsequently, units of Fund A were listed on 1/1/2018. 1/1/2018 means on the date of amendment. On National Stock Exchange. Mr. Raj sold all the units on 3/4/2025, our year, for how much each? The details relating to the quoted price on National Stock Exchange and NAV of the units are given below. NAV means net asset value. Highest trade price, average trade price, and what man? Lowest trade price. NAV on 31/1/2018 is how much, man? 800. Very simple question, man. Nothing. They have given some average and they are trying to confuse the students. Nothing. Sir, highest to lowest average and all saying. Come on. For the purpose of computation of long-term capital gain chargeable to tax under 112A, cost of acquisition in relation to long-term capital asset being an equity share in a company or units of equity oriented fund or units of business trust acquired before 1st February 2018 shall be the higher of. We already know. Either the fair market value as on date of amendment or full value of consideration, whichever is lower. Whichever is lower or actual cost of acquisition, whichever is, look at here, fair market value of such asset is 31/1/2018. Or the full value of consideration or received or accruing as a result of transfer of the capital asset, whichever is lower. This already we know. Sir, fair market value of the listed share on 31/1 is the what price quoted in the recognized stock exchange? Let me, 3 price has been given. What price, what price, what price? Sir, what you are going to find out? Cost of acquisition. You tell me, you want your cost of acquisition to be higher or average or lower? Higher. Then only it will be beneficial for the assessee. Yes, sir. Full value of consideration, we always want to be lower. Whereas cost of acquisition, we want to be. That's why the fair market value of listed share is the dash price. When I read it as average because every student will take in exam only average. But think the logic. I want cost of acquisition to be. Accordingly, the long-term capital gain on transfer of STT paid, which is listed equity share by Mr. Shagun, would be determined as follows. The fair market value of A Limited would be 700. Because for A Limited, they have given, man, sir, look at here, addition information. 700 or 680 or 660 or 700. Because it is the highest trading price. Am I right, sir? Being the highest price quoted on the National Stock Exchange. Are you clear with this point? The cost of acquisition of each equity shares in A Limited would be what? 700. Being the higher of actual cost, that is 400, and 700 being the lower of what market value? As on 31/1/2018, and actual sale consideration 1200. Because what is full value of consideration? 1200. Or what is the fair market value as on amendment? 700. Whichever is lower. What is lower? 700. Or what is the real cost of acquisition? 400. Whichever is higher. That's why 700 is the answer. Thus the long-term capital gain would be, sir, tell me, what is the full value of consideration? 1200. What is the cost of acquisition? 700. 1200 minus 700. 500 per share is the capital gain. For how many share? 300 share. So 500 into 300 comes to 1,50,000. Am I right, sir? Sir, long-term capital gain of 25,000, because this is covered under 112A. Under 112A, up to 1,25,000, it is nil. So in excess of 1,25,000 would be subject to tax at 12.5% under 112A, plus health and education cess of 4% without benefit of indexation. The tax on capital gain at, sir, 12.5% would be, sir, 25,000 into 12.5% comes to into 104%. That's what they straight away calculate as 13. In the sense means 12.5 into 104% they have taken. 12.5% is the tax rate plus health and education cess of 4%. So put together it comes to 13% effective rate they have calculated. Are you clear? Sir, in case of units listed on recognized stock exchange on the date of transfer, the fair market value as on 31/1/2018 would be the what trading price? Don't take average, again highest on the recognized stock exchange on this date if the units are listed on that date. Else it would be the NAV where the units are unlisted on that date. That means if any units have been listed now, take the highest trading rate. If the unit has been unlisted now, my dear lovable students, you have to take the NAV, net annual value, which is the cost of acquisition. Am I right? Accordingly, fair market value of the units of fund A on this date will be how much? 750. Look at the question. Sir, highest is what? 750. This 700 and 650. Put it on. Dustbin. So, 750 being the highest trading price on this date since the units of fund A are listed on that date. Sir, cost of acquisition of unit of fund A would be what? 750. Being the higher of actual cost, that is 550 or 750 as on 31/1/2018. Because what is the full value of consideration? What is the full value of consideration? 900 rupees is the full value of consideration. Am I right? What is the highest listed price on the date? 750. Whichever is lower. What is the answer? 750. So 750 or what is the real cost of acquisition? Whichever is. So what is the answer? That means, sir, 750 rupees unit you have sold for 900 rupees. Am I right? For one unit there is a profit of how many units you sold? So 150 into 200 comes to 30,000 will be the long-term capital gain. Am I right? Since the amount is less than 1,25,000, since a long-term capital gain on sale of unit of fund A is 30,000, which is less than 1,25,000, said sum is not chargeable to tax under 112A. Are you all really with me? Sir, look, this is with regard to Mr. Shagun. This is with regard to Mr. Both are two different assessee. Otherwise, sir, for income 1,25,000 you can't reduce it. For assessee 1,25,000 only you can reduce. What is the one line summary of this question? Nothing. One of the assessee transferred a super asset which is a listed equity share. For that, sir, SCT has been paid both at the time of purchase and sale. Then, since that listed shares has been issued before 1/2/2018, the cost of acquisition is full value of consideration or fair market value as on date of amendment, whichever is lower. Whichever is lower or actual cost of acquisition, whichever is higher. Am I right, sir? Fantastic. Sir, with regard, sir, if the fair market value as on 1/1/2018 or 1/2/2018 will be the highest value which has been listed. Don't take average, don't take lowest. With regard to units also one and the same. You have to check that whether the units are listed units or unlisted units. If the units are listed units, take the highest listed price. If it is unlisted, now take the NAV on that date. Go through all the 8 questions. Redo all the 8 questions. With this, technically, we can declare that we are done with the chapter capital gains, my dear lovable students.